Everyone loves the narrative of venture capital. Unicorn exits, the IPO build, the billions in valuation. But if you strip away the fluff, venture capital is just a very specific high beta asset class with a weird set of mechanics. Most founders, and honestly, most people do not understand the incentives driving the money. They think venture capitalists are simply like a group of Silicon Valley bros who are just in the business of funding good ideas. But that is very far from the truth. Venture capitalists are in the business of asset management and outliers. Today, I'm going to be doing a deep dive on the mechanics of VC, and we're going to be looking at fund structure, the math behind power law. Because I'm very sure many people hear about power law and they're like, what exactly is that? So, power law and the specific due diligence criteria that venture capitalists use to price deals. First, let's clear up a misconception. When a partner at the top tier firm writes a $5 million check, it's rarely their own money. Venture capital firms are structured vehicles. On one side, you have the LPs, which are the limited partners. These are the pools of capital, they're the pension funds, university endowments, sovereign wealth funds, family offices, etc. On the other hand, you have the GPs, who are the general partners, the ones who are actually in charge of the funds. The one thing they all have in common is that they are looking for alpha returns that beats the public markets. The GPs are what we call the capital allocators. Now, let's talk about the management fees. So in VC, you have 2% management fee and 20% carried interest, which we all call carry. The 2% management fees is what keeps the lights on, is what pays analyst salaries, while the 20% carried interest is a profit share. So let's say I invest $100 million and turn it into like a $300 million, and the profit is $200 million. The GP takes 20% of that profit, and this is where the generational wealth is actually made. The incentive is purely on exit value. Now, let's talk about portfolio construction and the power law. In private equity or real estate, you want a low loss ratio, you want safe, consistent returns. In venture capital, you can actually lose money on 60% of your deals and still be a legend. But here is the math. A typical early stage fund might hold 30 positions, 10 of which might return 1x, another 10 of them might return 2 to 3x, and then some of them might actually go to zero. But there has to be at least two or three that return 50 to 100x. That one outlier is the fund return, and that's the one that pays for all the losses and generates the carry. And that's also something that affects how VCs look at your pitch deck when you pitch them, because they're looking at your total addressable market. They're asking themselves, is this business something that can be worth $100 million down the road? Because if it's not like it's a bad business or anything like that. It just doesn't fit the portfolio mark. And that's something I think most founders do not understand, because most times when founders pitch VCs and the VCs don't end up investing, they're always quick to say, oh, maybe they don't have money. And you hear all of this on LinkedIn actually when they come and then they're like, how to not waste time talking to a venture capitalist. But so it's literally a thing where a VC is asking themselves, how big can this business grow? And if the answer is not so big, or they don't even understand the market and how big the market can actually be, they will literally just say no. Now, let's talk about due diligence. How do VCs filter the signal from the noise? When a deal passes the initial screening, it goes into due diligence. At this point, VCs are not just looking for cool tech, they're looking to validate their investment thesis. So they're asking questions like market sizing, they're looking at your total addressable market, your serviceable and available market, your serviceable obtainable market. They're looking at, is this market growing? And that's because they want to be swimming downstream, not fighting against the current. The next thing is unit economics. They want to ask, does this business model scale? Here they're looking at your lifetime value to CAC ratio, that's customer acquisition cost. If you spend $1 to get a customer, do you make $5 back? Next thing is defensibility. So what makes you unique? Do you have network effects, proprietary data, switching costs? What prevents margin compression when competitors show up? Also, you have the team. So the VCs are looking at the founders and asking themselves, why are these founders the best people to actually solve this problem? Do they have a unique insight? Do they have earned secrets that the market has not discovered yet? Here is basically answering the question of founder market fit. So VCs are usually trying to de-risk execution while betting on the market upside. Now let's go into fund mechanics. You need to understand the time horizon of a venture capital fund. The standard fund has a 10-year life cycle, and so this creates something like a J curve. In the early years, which is year one to year four, the fund performance looks terrible. And that's because at this point, the VC is calling capital from LPs, paying fees, writing checks. So portfolio valuations have not necessarily marked up yet. And then we entered the harvest period, which is year 7 to year 10. And this is when we need liquidity events like an M&A or IPOs. And why does this matter to you if you're a founder? is because you don't want to be pitching a VC who is in year 8 of their fund life cycle, because at this point in time, the VC is under massive pressure to return capital to LPs. They might actually push you to sell your company earlier than you want to, and they just put you under so much intense pressure. So it's also important for you to actually note, like, at what point in their life cycle is this fund. So what really moves the needle for you as a founder that is looking for investment? What gets a VC to actually sign your term sheet is usually a combination of traction and your narrative. So first, you want to be looking at product market fit. Here, you're looking at retention. Are your users sticking around? Are you spending so much on marketing? Do you have a leaky bucket? etc. The next thing is operating leverage. As revenue grows, your costs definitely grow. So are they growing linearly or exponentially? And the next thing is venture scale vision. And this is probably like the most important part out of everything I've said so far in this video. You need to articulate a path to $100 million in annual recurring revenue to any VC that you meet. So let's be realistic about the asset class. Venture is very high risk. The failure rate is astronomical, and most funds actually underperform the S&P 500. The portfolio managers are dealing with extreme uncertainty, and they accept that they will be wrong frequently. That's literally the job, right? So the job is not to avoid failure; it's to maximize the magnitude of success, and that's where power law comes in. So here is what you should take away from this video. If you're looking to raise capital, stop pitching a product, start pitching an asset that fits into the power law portfolio. Show VCs the unit economics, show them the market depth, show them why you're positioned to succeed, show them why you're an outlier, and literally that's how everything falls into place for you. Thank you for watching. If you want more breakdowns on the mechanics of finance, subscribe and I'll see you in the next video.